Aloha and welcome back. Our first lesson today is on Chapter 8, which is talking about receivables and bad debt expense. So the lesson is going to focus mostly on bad debt expense. First, we're going to talk about some of the advantages and disadvantages of selling on credit. Probably the single most important and the single biggest advantage of any company offering credit is an increase in sales. That's got to be probably the biggest single reason why companies decide to offer credit. There are several disadvantages. If you're going to do it right, you need to set up a credit department, which means you're going to have added costs to administer and run your credit department. There's going to be a delay in collecting your sales dollars. Since you're selling on credit, you're not going to be collecting on the spot. There's going to be a delay between the date of sale and the date of collection. And probably the biggest disadvantage, and pretty much a fact of life for companies that offer credit, especially large companies, is that there will be bad debts. There will be some accounts, some sales that will go uncollected. All things considered, most companies find that the advantages of offering credit, that big increase in sales, usually outweighs the disadvantages of doing so. And so many companies, many larger companies especially, offer credit. Keep in mind, when we talk about credit, we're not really focusing on a credit card sales or credit through credit cards. Credit cards are a different animal and are discussed in another chapter of this course. When we talk about credit in Chapter 8, we're talking about credit that the company is offering and administering in-house, their own accounts receivable. The method of accounting for bad debts under generally accepted accounting principles, the prescribed method, if you will, is referred to as the allowance method. The reason it's called an allowance method is that we need to use an allowance account. An allowance account is sometimes referred to as a valuation account. It's an asset account, and it pretty much exists along with the main account, which is the accounts receivable account. Accounts receivable carries a debit balance. Accounts receivable is an asset account and it carries a debit balance. The allowance for uncollectibles or the allowance for bad debts is an asset account, but it carries a credit balance. Therefore, this account is what we would call a contra asset account. It's an asset account that carries a balance that is opposite of the normal asset account balance. So the allowance account carries a credit balance. And over on the right-hand side of the equation, we would have our bad debt expense account. I'll go through the journal entries in a later lesson for this chapter. The steps that we use when we use the allowance method, the steps that we perform when we use the allowance method are first to adjust or estimate our bad debts. First step again is to estimate our bad debts. Now keep in mind that this first step is an adjustment that occurs at the end of our accounting period. Usually it's going to be done at the end of the accounting year. Some companies may do it monthly, but I would guess that most companies adjust for the estimate of bad debts at the end of each accounting period, at the end of each fiscal year. The second step, which is a regular journal entry that can happen at any time during the year, and in fact it can occur multiple times during the year, is the actual write-off, or the write-off of actual bad debts. Now, keep in mind, in the first step, we are estimating bad debts. We are coming up with an amount of our accounts receivable that we estimate or think we will not or may not collect. In step 2, for whatever reasons, whatever factors are made available to us, we have come to the conclusion that we will not collect on an account, and so we will actually write off a specific account in step 2. And then step 3 may or may not happen. Of course, anytime we have write-offs, that doesn't mean we forget about those accounts written off. Usually we would continue collection efforts of one sort or another. And so from time to time we may have recoveries of previously written off bad debts. So each of these steps would require a journal entry. In the first step, it's an adjusting journal entry, and in steps 2 and 3, those would be regular journal entries made at any time during the accounting period based on the circumstances, either a write-off of an account or a recovery of an amount previously written off. Now, when we talk about estimating our bad debts, again, this is the first step, adjusting or estimating for our bad debts. This is the first step in applying the allowance method of accounting for bad debts. When we estimate our bad debts, we have two different methods that are available to us. It gets a little complicated, as you can see. Not quite as complicated as the previous chapter on inventory and cost of sales, but this is still a little complicated. Anyway, we have two methods that we can use for estimating bad debts, and generally we're going to use either one or the other. However, in this case, unlike with inventory where you have to use either method of accounting for inventory and only one cost flow assumption, when it comes to accounting for bad debts, it is possible to use both of these methods for estimating bad debts at different times during the fiscal year. The first method is referred to as percentage of credit sales. It's also called the income statement approach because we focus on credit sales, which is an income statement account. The emphasis when we use the percentage of credit sales method is on matching bad debt expense with the related revenue in the same time period. Okay? So that's our emphasis, using a percentage of credit sales approach. Percentage of credit sales is talked about in the text on page 365. The second method used for estimating bad debts is the aging of accounts receivable. Because the focus is accounts receivable, which is a balance sheet account, as as opposed to credit sales, which is an income statement account. When we use the aging of accounts receivable method, that's sometimes referred to as a balance sheet approach. Our emphasis with the aging of AR method, our emphasis is on a more accurate balance sheet valuation of accounts receivable. Keep in mind, our allowance balance is meant to basically reduce the amount we show in our accounts receivable account, so that when both are taken together, remember, one is a debit balance, one is a credit balance, and so taken together we would always subtract these two amounts. Taken together we would calculate what we would refer to as our net accounts receivable, or accounts receivable net of the allowance for doubtful accounts, or net of allowance for bad debts. In other words, this is what we have in our books, this is what receivables are recorded on our books, and this is the amount that we think we will not collect. And so when we put these two together, we're showing an amount that we feel is a better valuation of our true accounts receivable. Hopefully that makes sense. This is a short lesson, and we'll follow up with a lesson that runs through some of the journal entries that are involved in applying the allowance account. There is one more thing I want to mention on the bottom of this last sheet. There is a second method of accounting for bad debt expense. It is not the prescribed method, not the method prescribed under generally accepted accounting principles, which is the allowance method. The method that is the IRS approved method is what is referred to as the direct write-off method. I think that's something that is good to know and file away in the back of your mind, because I'm sure in your on-the-job experiences as you move forward in time, you're bound to come across the direct write-off method of accounting for bad debts in especially smaller companies. And so with that, I think I'll wrap this lesson up and come back to another lesson on this chapter shortly. Thank you.